Okay, hi Holly. Good morning. So, what I'm going to do is I am going to do these in batches of five. I mean, I haven't marked your answers. I'll do that after I finish a batch of five. So we're just going to get through batches of five and get through this. So this is FR. First of all, so let's get through. Let's see what the question is, and just make them short and snappy so that you can do them and just get through as many as possible. So hopefully, if you think of it that way, batches of five, and then so that you're getting through as much as you can. Right. Okay. So let's start off here. With this. So we have here question one: which of the following conditions must be met in order to classify an asset as held for sale? So here we're talking about IFRS 5. So this is a standard that regulates, if you like, how we treat assets we intend to sell. We no longer want to continue to recognize them as non-current assets. They become current assets because the whole idea, if you remember, with the whole idea of a current asset is that it's to be held. Technically, current assets are held for, if you like, within a year. That's kind of the designation, so to speak. And so non-current assets kind of move into that non-current assets that we intend to sell, assets held for sale move into that category. So what are we saying here? So definitely we can see here it says the asset is expected. That's the expectation. So we're out there putting out adverts, letting people know it's very clear it's available for sale. So definitely we intend to sell it. Whether or not we don't sell it is a different issue. If it doesn't sell, it doesn't sell. That's fine. It's held for immediate sale in its present condition. So it's ready, if you like, to be sold. It's due to be marketed. No, so we must have already kind of put all that in place, marketing and all of that. So if you like, coming back to the concepts, and I'll try and do that because I'm now teaching on the SBR, Strategic Business Reporting, and I'm noticing how it's so important to relate the conceptual framework to a lot of this. So what we're talking about here is very much, if you like, about faithful representation, if you like, faithful. They're two key concepts. They're two fundamental qualitative underlying concepts: faithful representation and relevance. So hopefully you remember these again as you carry on. So what are we talking about here? It's 1 and 3. So C. Right. Great. Let's look at the next one. So this was C. And again, like I say, we'll come back and look at how you've done. What's going on here? So it says here, so again, because this is about faithful representation, and when I say relevance, the question of what is, because the conceptual framework wants us is very clear about the definition of what an asset is. These are all elements, liabilities, if you like, equity. So this kind of relationship. So the argument here is that for the if you like, the standard on financial instruments, when someone recognizes or issues a bond or issues a issues a bond, if you like, the question is, how do they recognize this? So typically you would expect that if you're issuing a pure liability, it's debit bank, isn't it, and credit liability. But we have something of an issue here because what you're doing here is it's not quite it's a convertible bond, so there is an element of equity in it embedded within. So the question is, we need to be sort of clear as to what bit relates to liability, and there is an element that relates to equity. So we know that you have received, if you like, 250,000 in the bank. So the question is, we must credit liability and credit equity. What element is this? This is ultimately what we're trying to find. What element here? So in effect, what's really happening, if you remember that this it says a convertible bond, nominal value of 250,000. What we have here is, this is the coupon rate. It says this is a coupon. When I say coupon rate, this is on the actual face value. This is the note. So the note is denominated, if you like, and call it 100,000s or 50,000s or whatever. So this is what you will be, if you like, paying out every year to whoever bought the bond from you. So whoever bought the bond from you will be receiving 5% of this every year in their bank account. So in effect, what does this now look like? So in effect, what we're really trying to do, if we want to understand what the liability element of this is, we literally now need to kind of, I'm just going to go to a blank page here. What we need to now look and assess carefully as well, what we're saying here is that you will basically pay out at the end of year 1, you will pay out 5%, year 2, 5% of 250,000. That's what will leave your bank account, 500 and 250,000. And in year 3, same thing, 5% times 250,000, as well as the actual 250,000. So in order to recognize if this was a pure liability, as we all understand, no one will, like I think I've highlighted in class before, no one will give you money, more money than what they expect in return, if you like. So there's no way, if this was a pure liability, this balance of 250 should be equal to the present value of all these figures, if you like. And so in effect, when we do all of this, when we look at the and again, this has to be discounted, if you like, at the current market rate, because this is the rate at which a loan will ordinarily be given. So let's just test. It's almost like a test. Is this a true liability? And therefore, to do that, I'm told that the discount rates they're given to you, if you like. And when you do that and you divide, if you like, these figures, I believe, just doing that very quickly, you have 0.05 times 250,000. So that's 12,000. This is 12,500, 12,500, 12,500. Then, but they give this to us in the exam, so which is quite good. So if we look at this here, they're given to you, they give you these discount factors to use. So in effect, I just need to multiply all those figures by those discount factors. So basically 12,500 times the discount factor, 12,500 times the discount factor, 12,500 plus 250,000 times the discount factor, and that would give me my the present value of that liability: 0.93, 0.72, 0.82. Where are we? Let's go back. 0.93. I believe this is what the figures were. So when I do that now, you will get 12,500 times 0.93 takes us to 11,625. 12,500 times 0.87 takes us to 10,875. And when you do 12,500 plus 250,000 times 0.82 takes us to 215,250. Add all that together, plus 10,875 plus 11,625 brings us to 23,750. So going back to my initial analysis here, it must mean that if you have received in your bank 250,000 and the present value of what it is you'll be paying out later is actually less than that, you must have offered something else as well. So that's the 237,750. It means the balance must be equity, and if I subtract that from 250,000, I have 12,250, and that's how we calculate the equity amount, and that's why the answer is D. Okay, great. Let's move on very quickly to number 3. This is IAS 8. This question is asking about the restatement and retrospective application of financial statements. So IAS 8 says to us, well, again, this is for faithful representation, because this wants us to make sure there's completeness, so we can compare. Actually, there are there are 4 underlying conceptual framework requirements as well. So timeliness, comparability, and so on. So if you have this type of thing, so here definitely a change in accounting policy 100%, you need to go back, and that's retrospective. Estimates, I'm sure you know, these are only prospective. We only go forward. So things like depreciation and things like that, as in reducing balance to whatever straight line method. This is all forward thinking. And a material error. This is a good one here. If it was just a normal error, you would think about it. Is it worth going back? And the conceptual framework always wants us to think about the cost implication, focusing on the cost implication as well. Is it worth it? So 1 and 2, and there we are. B. That's B. Right, how am I doing for time? 9. I want to try and make these snappy. Let's move on very quickly. So here we are. So this is an investment property. So IAS 40. So there is, I mean, there's a major standard on fair values to really give us a guide. And if a faithful representation, if you're having an asset in your financial statements that, and you're using the fair value model, the truth is that we really should be recognizing the movement straight to the profit and loss account. So really, it's almost a case, and you will see this when you come to look again at financial instruments later on. But the key point is that the profit, in terms of fairness or a good understanding of the statement of profit or loss, statement of financial position, means that you're realizing those profits straight away. This is what's going on. So for investment property IAS 40, the standard itself specifically highlights that you must recognize the profit straight away in the profit or loss. You see, the idea of the other comprehensive income is if you're really holding, if it was never really for sale, you're holding it for the long term to gain the cash flows from it. Here, the idea of investment property is that if tomorrow something came up, you would sell it, right? You would let it go. So ultimately, um, whenever you have those scenarios where you are willing to trade, almost hell for trade, it is realizable straight away in the profit or loss, which so it's going to either be A or C. So the question here is, do we depreciate? No, we don't. There is no depreciation. We're holding this thing for trade. We might sell it in the middle of the year, so there's no depreciation. So what we literally have is a fall in value of from 3.5 million to 3.25. If we had it in there, if it wasn't an investment property, yes, then you would carry out depreciation. So if it was on your normal, as part of your PPE using in terms of trade, no, here we're holding this to sell if something else, to make profit. So we have a loss of 250,000 hit our income statement straight away, um, um, because it's fallen in value. Okay, great. And then finally, what I now have here is this. Let's look at this question. Um, Here we have Duck Co. purchased an asset for 250,000 on the 1st of July. So what we have here is we have asset 250,000, and you've got a grant, and it says you want to do this on a deferred credit. So it means here what you have is you have bank, you have got 30 grand, and you have deferred income 30 grand, and so you're going to release this yearly over 12 years as you use the asset. And so we can see here that it has a useful life of 12 years. So in effect, each year you would release 30,000 divided by 12, which comes to 2,500. And what can we see? You have used it literally, that's X3 and X4, so you have released 2 years of this into this. So what do we have? You were released 2 years, so that's two, so that's 5,000. So you have released 5,000 of this into the against the asset, and in effect, um, if well, sorry, well, against any depreciation. So 5,000 here, and then whatever the depreciation is. Oh well, yeah. So you would depreciate the asset 250,000 over 12 years. Let me just do that now. 250,000 divided by 12 is 208, weird number. So you have 20833 each year when you're depreciating this asset, but you can release again 2,500 each year. So you've done this twice over, so to speak. But the question is really asking what is the balance on the deferred income. So over 2 years, so the balance will be 25,000. Okay, great. That's the end of the first set of 5 questions.